Hello all and welcome to RiskOut's webinar, BSA AML Decoded, breaking down risk scoring. We are so excited to have you all joining us here today. Now, before we dive into today's webinar content, let's roll through some quick housekeeping items. RiskOut will be sharing all of today's webinar resources, including the slides, any handouts, and the recording in a follow-up email, so please keep an eye on your inbox. We always want these sessions to be as valuable for you as possible, so we encourage you to ask any questions that you may have throughout today's session in the questions section of the webinar panel on the side of your screen. We will be running a few polls throughout today's webinar to better understand our audience, and your participation is greatly appreciated. For those of you that are joining us for the first time, RiskOut is a team of former regulators and examiners, BSA professionals, and fintech software experts who are building better cloud-based tools to help community financial institutions grow and become more efficient. We are funded and influenced by over 200 financial institutions through Launchpad and Castle Creek, Bankers Helping Bankers Fund, and the Alloy Labs networks. We are a true partner and not just a vendor, which is why we're proud that 100% of our customers are referenceable. If you're interested in learning more, visit riskout.com and get in touch with us. Now, we here at RiskOut are embarking on a mission to take the BS out of BSA. Manual processes for transaction monitoring, risk scoring, and SAR filing are too tedious, and legacy BSA solutions are often slow and dated, causing inefficiencies in the day-to-day back office operations. That's why we're developing a new solution, and we want you to be a part of it. If you're interested in working directly with RiskOut's product team, like today's presenter, you can provide feedback and collaborate to build the transaction monitoring system you wish you had at your fingertips, so you can join our Founders Program by clicking the link in the chat box. Next month, RiskOut will be hosting part 2 of this webinar series called BSA AML Decoded, Unpacking Transaction Monitoring. Transaction monitoring is the heartbeat of your compliance program, and monitoring transactions effectively is vital to identifying suspicious activities, maintaining compliance, and fighting financial crime within your community. In this June webinar, we'll cover effective monitoring strategies, some weaknesses of some more common methodologies, and how to better protect your financial institution. After that, we'll have part 3 of our webinar series, BSA AML Decoded, Investigations and Case Management. We'll dive into your compliance team's detective work and how you piece together those financial clues to combat crime in your communities. Our experts break down investigation and case management strategies through real-life scenarios and experiences to help prepare your program. So this is a session you definitely won't want to miss. Visit riskout.com's resources section to reserve your seats for these exciting upcoming sessions. All right, and today's webinar is led by Ryan McInerny, the Director of Product Strategy here at RiskOut. Ryan brings a wealth of regulatory and technical experience to his role, as he was a former national bank examiner with the OCC. At the OCC, Ryan was a member of the Northeast District Committees for Compliance and Commercial Credit, where he helped to identify changing industry trends and risk conditions. Ryan also brings a strong business sense with his banking expertise, having received his master's degree in business analytics from UVA's Darden School of Business. We are very excited to have him joining us here today. And without further ado, I'll go ahead and pass it over to Ryan to dive into today's agenda. Take it away, Ryan.
All right. So getting started, today we're going to be going through risk scoring, just kind of a general background about what happens in risk scoring, how it differs across industries, and more specifically, how it differs within your financial institution. Why has BSA risk scoring not evolved as much as other parts of the financial institution? And then some new approaches, things that we've been thinking about to try and make risk scoring more effective, more useful for financial institutions. At the end, we'll have a more formal Q&A, but I would encourage you as we're going through, I do tend to get pretty deep into some of these topics. So if you have questions as we're going, please feel free to just shoot them into the chat. And Ethan has been given full authority to interrupt me and ask those questions so that we can kind of have a dialogue and make sure you understand what's happening when we're talking about it. And so without further ado, we'll start jumping into risk scoring, the background of risk scoring. I will apologize in advance that I do not have the commentator voice that Ethan does, but you will have to deal with how I talk, which is sometimes a little fast, and I can also apologize for that. So what is risk scoring in BSA and AML? Well, this is Ryan's definition of risk scoring, and it's the stratification of customer or member segments in order to apply acceptance criteria and due diligence processes that align with the entity's potential for money laundering, fraud, and terrorist financing. With any risk scoring or any scoring system, it's a statistical exercise in trying to identify something about that party and putting them into different categories that have different results as a result of putting them into that category. So stratifying these customers or members is really important, but it also is something that has to be rooted in what you're trying to identify. And so if we're not really thinking about what goes into risk scoring, those factors that really influence the likelihood of money laundering, then our risk score really isn't doing what we need it to do. So why does it exist? Well, the original BSA, even though it wasn't necessarily called the BSA at the time, was founded back in 1970. At that point, there's basically a responsibility added to financial institutions for trying to combat money laundering in their financial institution, not just allowing that to proliferate throughout our economy and throughout our banks and businesses. In 1992, with the advent of the AML Act, we saw more stringent repercussions for financial institutions that did not adhere to the BSA. And then when we get to 2001 with the USA Patriot Act, we see much more well-defined information sharing requirements, more well-defined reporting requirements, and more importantly, more well-defined guidance and information from the FFIEC on what's really important in a BSA program. Specifically, there's some information there about how we stratify customer risk. And so that's what I want to pull up first, is this absolutely beautiful graphic, which is shown in the appendix of the FFIEC manual. Now, I mean, today you're probably going to see a little bit of a better looking bar chart than you will right here. But what's important if we're looking at this is really just kind of this stratification of what it means when we stratify it across different categories. So customer risk isn't just I assign a risk level to a customer member and say they're low, they're medium, they're high, and I move about my day, and that's the end of things. In reality, what we're looking to do is identify the potential for money laundering of that entity, and then figure out what are the actions that I have to do as a financial institution to limit the likelihood that they are going to be laundering money through my enterprise. And so you can see some of the examples here, right? If we're looking at just a normal customer on this bottom one where it's basic profile, generic threshold monitoring, right? So they're just running through your transaction monitoring system on a day-to-day basis. Great, and now we're basically managing that by exception. So if there's an alert, if there's something that gives us a reason to look into them more, then we're going to do it. Versus as you get to the higher risk level, think something like really cash intensive businesses like MSBs or cannabis businesses. Now you're starting to add things in there like transaction monitoring that's customized to that industry, or due diligence questionnaires that are customized to that industry. The idea here from a financial benefit perspective of the financial institution is if I can place customers into the correct bucket, I get to do less work on them. And if I can place customers into the correct bucket, I can also minimize the likelihood that there's money laundering through my bank, which also means less chance for regulatory fines, reputation risk, different things like that. So historically, what are some of the problems that we've seen in BSA and AML risk scoring? The first is typically it's been this really simple high, medium, low methodology. And for that, a lot of the times, whether someone's in the high category or the medium category is just kind of this true or false variable. So it's is my entity in MSB? Maybe we're automatically putting all MSBs into the high risk category. Or is my entity a non-resident alien? Maybe we're automatically putting all non-resident aliens into the high risk category. And typically that kind of one size fits all approach is not as accurate as we want it to be. And we end up doing more work on customers that really aren't as risky as we think they are. Past just that simple high, medium, low approach, the risk scoring of BSA AML has typically been a little bit isolated, a little bit overlooked. We'll show an example here in a moment of what you really see in the rest of risk and credit in the financial institution. But a lot of times the BSA piece of that is not tied in there. When we go to the next one, we're looking at the fact that BSA AML risk scoring is not tied to a financial impact. And that does cause a variety of different issues, because it does have a financial impact. When we look at a risk score, say a high risk customer, that means I'm spending more time as a financial institution managing that customer member. When I'm spending more time managing that customer member, that means I'm spending hours, which is a direct cost to our financial institution. It also limits where we can go into, say, like new or maybe expand into existing markets that we already have, where we can try and get more revenue. But if we're not thinking about the cost to manage our customers or members based on category, then we might be taking on customers and members that are actually more costly than we think. And lastly, as I mentioned, a little bit more robust in credit and risk side. So what I'm showing you here is a general credit risk rating graphic. And so you're going to look at a few things here. So you see on the left-hand side, the borrower rating has a scale of 10. And then after that, that's 10, that level 10 scale, we have an actual risk level associated with it. Now, the next piece, which I think is the most interesting here, is the probability of default. And so there's a tangible effect that's associated with each one of these risk levels. So for the borrower rating 1, we see that it's almost negligible, the chance that they default on their loan. But as we get to the end here, you can see in level 10, where this individual is actually bankrupt, right? They're more than likely going to default here. So this gives us an idea of, is this, does this customer member need more work? Does this customer member pose more of a risk? And if so, now we can start to talk with the risk department. We can talk with different parts of the financial institution and make sure what's the best action for us to not lose money on this. In our case, if we're applying this to BSA and AML, it's going to be, hey, this guy is more than likely going to be laundering money. What should we do here? Like, we should probably make sure that he's not laundering money through our bank. All right.
Alrighty, that brings us to our first poll question of the day, which you should see popping up on your screen right now. That question asks, do you find your risk scoring solution to be an accurate and useful tool? Now, we've got a couple different options. You can go, yes, absolutely, it is both accurate and it is useful. Or you can split hairs a little bit and say, sure, it's accurate, but let's be real, it's not very useful. Maybe it's the inverse. Maybe it's super useful, but it's not very accurate. Or finally, maybe it's just been a tough week and you're saying, no, it is neither accurate nor useful. We'll give y'all a couple of seconds to get your responses in here, but we'd love to see where you're at today, how it kind of stacks up to what we see in the market. Alrighty, it looks like we already got most of our responses in. I'll give you just a couple more seconds. Okay, let's see. So as we turn these results around, you should be able to see how everyone clocked in. We've got a relatively even spread across the board, all things considered here. Looks like the most common result, 35%, said that, sure, it is useful, but it's not quite accurate, which I think is pretty interesting. 30% said, yes, it's both accurate and useful. It's great, you're getting all the juice from the squeeze that you're looking for, followed by accuracy without usefulness at 20%. And then fortunately, only 15% of our audience today is getting neither accuracy nor usefulness from their solution. Ryan, I'm curious, how does this stack up to what you were expecting to see?
You know, that's kind of the way I thought it would go. You know, risk score can be useful if we can get them right, but a lot of times it's not exactly what we expected. Maybe there's some reason we have to override it, or maybe there's some reason that we know that that individual shouldn't be falling into that category. And with all that kind of extra manual work, moving people around, not being granular enough past that to say, I can apply different due diligence approaches for these different entities within the same risk category, it does end up sometimes causing more work than it's worth. And that's also something that you'll see from the regulators, where they start to come in and they're like, well, why does this look all so weird in one risk category? So makes a lot of sense.
That's great, y'all. Thank you so much for sharing those responses. Ryan, I'll let you get back into our slides.
All right. Can you guys see the slides? I'm still seeing the poll.
You know what? I am also still seeing the poll on my end. Let's see. Let's try and share the results and then put those away again. Any luck on your side? Is it still showing up there?
Still showing up. I'll end the share and just start it over.
Yeah, that'd be great. I'm sorry about that. I'm not sure why it's sticking around for us.
No worries. All right, and we're back.
There we go.
So effective versus ineffective risk scoring. You know, we've kind of started talking about this a little bit, but mostly we've just been talking about background. So let's start to talk about what makes a risk score less useful. So failing to tie results to specific actions. What we're talking about here is, say you do have customers or members that are falling into the high risk category. Well, what are you doing next as a result of them being in the high risk category? How does it change how you manage that customer or member? The next is inaccurate or heavily overridden results. I think overridden results are a plague in the risk scoring kind of landscape, particularly when you have different behaviors like seasonality or something like that that goes into, say, the transaction monitoring side of things, and you start to get all these false transaction alerts. Those start to roll through into your risk score, so you end up just basically fighting your system to get someone into the right bucket. And if you're doing that, you're spending more time really on some bureaucratic kind of systems issue than actually managing your customers or members. And then the last two are overly generalized ratings or overly specific categories. So in the example before, we saw that 10 scale rating as opposed to the 3 scale rating. For BSA AML, that might be too many, but having it overly generalized, where maybe it's only a scale of 3, or there aren't enough factors to place customers or members into the correct 3 scale, you're just going to be doing work on customers or members that you shouldn't necessarily have had to do in the first place because they were lower risk than they're being bucketed. So let's look at an example here of what you might be doing, your institution and others, in the event that you have customers or members thrown into these different buckets. So we start looking at the stratification of those risk scores. We have low risk, moderate risk, and high risk. So the first step, every single one of those is going to have general monitoring. That's the, say, like our OFAC scans, transaction monitoring, that sort of stuff, the basics. After that, that might be the only thing you're doing on the low risk side because you're managing them by exception. So if alerts happen, you'll start to review them more, but other than that, they're good to go. For your moderate risk and your high risk customers and members, that now you might be doing additional due diligence gathering. And that could be periodic information refreshes, that could be some third-party research, but something else that gives you comfort that that entity is still behaving. They're not an elevated risk of money laundering. And then we continue to get more and more in depth. And now in the high risk, we have those custom monitoring rules. So for example, risk out, where we started primarily in the cannabis space, this would be something like variance tracking, where we start to look at more in detail information about the financials of those cannabis companies. And a lot of times these custom rules are going to be specific to an industry or to a type of business that is doing a more risky type of behavior. We've also seen the same thing here for say money service businesses, BaaS relationships where you're managing fintechs, or say like another lender relationship, where you've started to tailor these rules, these reviews in line with the activity of the entity who you're reviewing. So we're going to look at here is a policy example. This was something that we would typically see as an examiner or an auditor if you're going into a financial institution. It's a pretty general policy. So the policy will talk about how they rate their customers, and then some general kind of feedback on what's going on in those different risk rating categories. So if we start off here, when we look at customer stratification, the financial institution in question says they rate their customers or members on a 3-tier scale. It's done through a series of rules. As you can see here, those rules aren't actually spelled out within here, just say we're using those rules. Then, for example, if a customer is in the cannabis industry or cash intensive business, they'll automatically be listed as high risk. So if there's not anything more in depth here, right? If you're primarily just looking at, say, industry, or you're primarily looking at a couple items that are bucketing people into high, moderate, or low risk, I can almost guarantee that more customers and members than you want are going to be put into the high risk category. This can cause some issues for you, particularly if you start to realize that too many of your customers members in the high risk category, and your methodology is simple like this. Your auditors and your regulators are going to fight you a little bit on taking people out of that category, even though you know they're supposed to be out of that category. Because if your system said that they were supposed to be there in the first place, why do you know better than the system does? And that can be an argument, which is frankly kind of ridiculous, given you probably know your customers and members a little bit better, but it does happen. The other piece we're looking at here is on, as we go into the specifics, and as we saw in the FFIEC appendix, and we see here, you're going to be gathering, say, due diligence a little bit more frequently. And so in this example policy, we're gathering due diligence annually on our high risk customers or members. What I will say is, even if that is being done annually, saying due diligence in this policy does not mean that your due diligence is the same due diligence for each high risk business. You probably have an appendix or procedure somewhere that have specific due diligence for different industries. And those could be more general as well, but it's really important to have them kind of honed in on a segment or a customer or member type. So when I say general, I'm talking about, I might have ATMs, MSBs, and convenience stores all wrapped up in a single due diligence package that covers the most important things for me there. But I'm not going to have my cannabis companies and then all of these other high-risk companies having the same exact due diligence process, because I'm probably not going to get the information I need. Now, given that
Ryan,
is a little bit...
Yep. Sorry to interrupt. We had a question come in that I wanted to ask you before we move on here. The question asks, you mentioned that manually reclassifying people is a big challenge for a lot of BSA programs. This individual wants to know, is it better for them to tailor rules for individuals that fall outside of the norms, so they'd have a much longer rule list? Is it better to spend the time making those perfect rule sets, or should they just stick with manually reclassifying these people as they come in?
I think that really depends on the situation, and that's like the most regulator answer I could ever give, is it depends. But I'll give you two examples. So in one case, say you have a few customers or members that you onboard each year, and those few customer or members, given your current rule set, might not fall into the right category, and so you just override those ones. But it's not usually the same exact thing. And if you were to create the rule, and then that rule would have to be altered every year, and it's just causing kind of like more of an upkeep issue, particularly on, like, say, your annual reviews of what does my rule set look like? Do I still understand why I made this rule, right? If it's not a lot of customers or members, then I'd say that's probably over complicating your risk scoring system. Now, if it's, say you have like 100 customers and members or 500 customers and members that you're taking in every year, they're just going into the wrong category, that's way more work than it should be for you. It also indicates to me as an auditor and examiner that there might be something wrong with the methodology in your risk scoring system. Why isn't it getting it right? Why do you have to fix it all the time? How can I trust it in different areas? Frankly, I mean, you should be asking yourself that question as well if it's not getting it right all of the time. And I think it depends. The last it depends is the kind of system that you're using. Is the issue that you have to create all of these new rules, or is there a way that you can set it up where your rules aren't automatically putting someone into a high risk category because of some other factor? So it could also be just kind of changing the parameters, or maybe turning like a rule off or something in the system that's misclassifying. But the more accurate you can get it without having to kind of bang your head in a wall each year, going through and saying, oh, it's still wrong, the better. But it is a time exercise. You shouldn't be spending all your time just tuning this thing.
That's probably perfect. Thank you so much for that.
Yeah.
Of course, we'd expect nothing less from a former bank examiner. Thank you for that, Ryan.
Okay. So let's jump into some examples of where this kind of inadequate stratification can cause problems. I think this actually kind of ties a little bit into that question. So if we look at example 1 here, right, if we're just looking at the industry of customers A, B, and C, we see their money service business, convenience store. If in my system I'm automatically categorizing by industry, it might be that these are all high-risk customers or members. And so do we think that's correct? Do we think that's accurate? You know, it's I don't think there's really enough information there. But with a lot of the ways that our BSA and AML risk scoring systems are set up, as soon as you have an industry, say it's via NAICS code, say it's whatever, it's something like this, it's automatically going to put it into high risk, and now you have that most stringent review that might not be accurate, but you're forced into that because of the lack of depth in the risk scoring methodology. So let's add some more detail on customers A, B, and C. Now we see what the account ages are. So on customer A, we know they've been around for 5 years. We might have a little bit more comfort with them. We understand the patterns. We understand what they're doing. We know how to review this and really make sure they're not doing anything nefarious. For customers B and C, they're both new. They've only been here 6 months. They haven't even been through their first annual review. So should they be the high risk ones? Should customer A not be a high risk one? Again, it's a tough question just having this information. But now if your risk scoring system is only considering a couple variables, they're all probably still going to be dumped into the high risk bucket. And then we get to the final piece of information is the transaction volume. So now we know customer A, despite the fact that they've been around for 5 years, is just pumping $5 million worth of volume in per year. Customer B, it's only been 6 months. They've got $1 million in there. And then customer C, it's been 6 months. They've got $20,000 in there. So again, where does the risk kind of fall within these relationships? If we're going strictly by these true or false rule set categorizations, they're all probably just going to be dumped into the high risk category. They all have a very similar monitoring and review profile, which might not be appropriate for the differences we have here.
All righty, that brings us to our second poll question of the day. And that asks, how often do you find yourself needing to override risk scores? You can select any of the following responses. Those options are most of the time, about half the time, sometimes, but not too often, and never, maybe you never override your risk scores, or finally, the classic, I'm not quite sure. We'll give you all just a couple of seconds to get your answers in here. Curious to see how this pans out. Alrighty, seeing these roll in, looks like we're weighted in a particular direction on this one, a little less evenly spread than on the last one. I'll give y'all just a couple more seconds. Alrighty, I think we got enough to be dangerous here. Ryan, I'll flip these results around and you can see the overwhelming majority, 64%, responded that they are changing their risk scores, or overriding risk scores sometimes, but not often. The second place winner there with 18% is never. So that's pretty good. People are pretty confident with what their setup is. They're not having to alter it too much. Maybe they just don't want to. And then finally, we have a pretty even split between most of the time override. It's about half the time overrides and not sure. Ryan, what do you think about this? How does this stack up to what you tend to see when you're talking to banks?
Again, makes sense. When you're looking at the general kind of disparity in a customer member pool, there's going to be a lot of just standard customers or members that we're not going to touch. That's probably 90% of the people at the financial institution. Then you start to get into, say, more complex business relationships, or maybe not even complex business relationships, but it's just like something that's a little bit off about a business or an individual, and your system is just going to categorize them because of that, even though you know that there's some piece to it that means that they shouldn't be in that category. And that's where you start seeing more of these changes. Becomes even more of a challenge where you start to see half the time is probably when you're doing some sort of specialty banking, where there isn't a customizable rule, or you can't get the system to change a little bit and it's just forcing things somewhere and you have to keep going over it again and again and again because of that lack of flexibility. For some of you that said you never change it, that was also something we saw on the regulatory side, was some financial institutions just left it regardless. Your regulators, your auditors will be supportive of you, I would hope, in the event that you say, I changed a couple of these because we know XYZ facts on this customer. That's why they kind of break the mold. So I would encourage you that if there are some that you think are in the wrong category, I mean, at least you have the opportunity to try and right size that. It might be worth having that conversation with an auditor or regulator if you think it's worth it.
That's great. Thank you so much. And thanks to all that responded here. Ryan, it looks like we might have our poll question stuck up there again. So if you wouldn't mind resharing your screen, I think we'll be ready to rock and roll.
No, it's really not letting me. There we go.
There we go.
All right. Here's a fun monstrosity that I thought I would show to you all. If we start to go back to stratification and risk on other parts of your financial institution, this is again another example from the credit side of the house, from the lending side. What you're looking at is that probability of default that we were talking about before on the y-axis, and then on the x-axis, you're looking at the loss given default. And so what they've done here for this risk scoring methodology is basically said, this person has a 50% chance of defaulting. And now if I look on the x-axis and say, oh, I went backwards. If I look on the x-axis and say they've got a 50% loss if they do default, now I know that I would lose 25% of the total balance in the event of a default, and I expect to lose a 25% of the balance because they have 50% probability of defaulting, and I expect a 50% loss when they default. And as a result, that's 25% expected loss. So that's how this kind of rolls into those risk ratings. They say this is our potential exposure at default, and it can be used to assign that corresponding risk rating. As we've seen financial institutions start to get more, as they start to get heavier and heavier into the analytics side, trying to forecast potential losses, this kind of strategy has become more and more commonplace. It was also basically forced by current expected credit losses, which we're not going into because we'd need a whole series on that. The point here being is when we look at these areas outside of BSA AML, there's a lot of statistics that are being applied to figuring out what's the likelihood that something even goes wrong here. And that's how we're setting those risk ratings, as opposed to what's happening for us in BSA AML, where it's just kind of this arbitrary, this person's in that industry. I don't have any kind of like hard numbers or anything else that says this person has X% more money laundering risk. But there's just kind of this this fear around, say, an industry or a behavior, and we just automatically throw someone into the high risk category or throw someone into the moderate risk category. And that often is just wasting our time as the compliance team that's trying to oversee this and take the time to make sure that someone's not doing something nefarious. We're putting more effort into people that are not as suspicious, and that's just inefficient.
Hey, Ryan, we did have a question that came in about the weighting aspect. This person asked if there's a general rule of thumb for how they should be weighing industry type when they're looking at their risk scoring setup.
That's a great question. So industry type, I think a lot of it is actually, so you can say, I'll skip to it. Let's see if I have it in here somewhere. Okay. So this is how we've been looking at it at RiskOut, is if you start to look at the profile, we have industry under the profile of that individual. And so the profile is the inherent likelihood that someone launders money. So in your experience, you're kind of the expert at your financial institution. There's going to be people that try and tell you all cannabis businesses are at a higher risk of laundering money, or all, let's say, car dealerships are at a higher risk of laundering money. But that's not necessarily taking into account your geography, your customer base, and any information that you know about that base of customers or members that might not be in line with, say, like national statistics. So for you, you probably have some ideas about whether an industry is higher risk or not for you in the likelihood of laundering money. But then you can start to layer in other items, which I think is what's important. So you can know just generally, yes, I think cannabis, money service businesses, I don't know, let's say non-government organizations or charities. I know those are at least higher risk to an extent. So I'm going to flag that as like piece one of an elevated inherent risk to this individual. And then I start to look at how do they actually behave. And that combination of what they are and what they do is what I use to put the score together. I don't rely on that one thing, although I recognize that that one thing has some weight to it. So that kind of circumvents your question a little, because I think what you're asking for there is kind of like a specific weight, like a number to it. And I think that can vary based on a lot of different conditions. But if you're kind of breaking this into the two pieces, which is how the customer member is, and then how the customer member behaves, you put it on that, at least on that how they are side, like what are they? That has a weight to it, but I can't give you a specific number.
That makes sense. Thank you. I think that answers the question well. I'll push on you a little bit more and I'll ask, is there a general rule where, you typically say maybe it's a 50-50 split between profile and activity? Do you tend to weight one more than another? Or is there maybe the opposite? Do you tend to see challenges when one is weighted way more than another?
So I wouldn't actually necessarily say that I'm weighting them like that. So let's just say it's 50-50 for the sake of the example. Let's see. So if we look at a matrix, this again is an example of how we've been thinking about it, is if you put the profile on a tier A, B, and C, and you put the activity on a tier 1, 2, and 3, and then I can start to combine those and put those into different risk categories that I've selected. It doesn't become as much of a weighting exercise as it becomes a how does my customer behave, or how does my customer member behave, and then what is the inherent risk of this customer member, where do they land, and how does that affect my due diligence, how does that affect my ongoing reviews. You start to tailor those to that category of risk that you've placed somebody into. But the strict weighting of like 50%, 60%, I think mathematically, if you're looking at this, it's probably 50%. But it really comes down to how you've selected whether like a high activity and a high profile risk would lead to high, or if a moderate activity and a moderate profile risk is moderate or high. It's really the risk profile that you have that starts to determine that.
Thank you for that. I think we got a confirmation in the question box there that answered their questions. Thank you so much.
Well, I feel like I was all over the place with that, so I'm glad that was actually a understandable response. So jumped around a little bit. Let me go back a second. I think this is where we were. So anyway, what I'm talking about here is just kind of a new approach for this, is looking at activity and profile, bringing it all together, determining an overall score from those two pieces. And you can apply this to a lot of different things that you've seen in your financial institution. So if you talk to people that are in, say, business continuity planning, they're going to show you there's two ways of measuring that risk. You have the inherent risk, and then you have residual risk after controls. If you talk to the credit risk department, they're talking about that probability of default, exposure at default. And then if you start to talk to, say, risk in general, they're probably talking about the amount of potential risk from, say, like hourly cost of you managing that customer member versus the amount of revenue they're bringing in. So all over the financial institution, we've seen kind of this matrix, this grid, as the way that we're measuring risk. And for some reason, it has just not transferred over to BSA AML. And that has forced us to have a lot of these kind of overrides for more unique situations. It's forced us to kind of try and shove a square peg into a round hole, which I tried to do as a child, but I stopped once I reached elementary school. So this, going back to our example before, and this kind of hammering the same point, is when I looked at customers A, B, and C, each one of them had different pieces on here that were high risk. Each one of them had different pieces that were, well, one had a moderate risk and two had low risk. Depending what I consider to be the most impactful in these categories, I might choose overall scores that are different. So for example, on customer A, knowing that the industry is high risk, but being very comfortable with the entity, but then seeing that they do a lot of transaction volume, I might keep them in the high risk category. But now, say I look at them again and it's money services, 5 years, and the transaction volume is that 20,000 or 30,000, that might not be as high risk for me. I mean, the potential for real true money laundering with that low volume is really not there, and I'm putting too much work into the customer or the member, despite that lack of potential risk. Alternatively, if we look at customer B, maybe they were dropped into the moderate risk because of volume, or maybe they were dropped into high risk because of industry. It's just, you have a lot of characteristics here that you can think about and try and massage a little bit differently than just automatically dumping these people into a high risk or a moderate risk bucket. All right, we talked about this a little bit, just this matrix of, I think the matrix is a better way to start to figure out where these customers and members land, and give you an opportunity to not just force someone into the high risk category, not just to force someone into the low risk category. When we look at this example here, say I have a high risk industry, but I have low activity risk, that might have someone landing in a moderate risk. That's why this would be showing as yellow. Now, alternatively, if they still have medium risk on the activity side and they're in a high risk industry, I'm going to keep them in high risk. And so just kind of selecting where these two X and Y variables put your customers or members, and having due diligence reviews, processes in place to manage a customer or member that's in line with this more granular risk approach. This is just an example of how we're visualizing that. So in a scenario, let's say you have a customer member that's in the cannabis industry, they are in a high intensity drug trafficking area. You look at the different factors here that are affecting the score. You see that that's going to be the high risk on the profile side, that's moderate risk on the profile side, but you keep adding those together. That's just adding risk. And then depending on what the activity was here, for activity on this one, they were under a year old. And so as a result, that put them as moderate risk on the activity side. And so that moderate risk with a high risk profile put them into the high risk category. Okay, so in summary, risk score categories are better when they reflect the level of money laundering risk posed by the customer or member. So not just kind of arbitrarily putting people into these different buckets, because I think that's just adding more work than we really want our staff having to do. The risk scoring should be granular enough to correctly place those customers members into a risk category that suits the due diligence requirements of the customer member. So whatever they're doing, they should be placed into a space where we're gathering the right information, we're doing the appropriate amount of review on a timeliness basis, on a content basis. Not to say that there's not going to be overrides, because there probably always are. And then lastly, that due diligence is tailored within each risk category. Typically, this is an appendix to your policies. You might have those specific due diligence questionnaires or specific reviews in your procedures or in the appendix to the policy. But just making sure that your regulator isn't coming in, seeing your policy says you do 3 things, then it's the same thing for everyone. Try and be a little bit more specific to your higher risk customers or members in the events you have them. All right.
All righty, y'all.
I was just
Yeah,
gonna say, I know there's a lot of information in there. It's probably some topics that a lot of us haven't seen before. So outside of these questions, if you want any more information on any of this, always feel free to just shoot me an email.
Yeah, thank you for that, Ryan. And we do still have a couple minutes here for any questions that you may have. I encourage you to throw those in the questions tab. While we're giving people a couple seconds to get those questions in, we do have our final poll question of the day. And that asks, would you be interested in speaking with Risk Scout about any of the following? You got a couple of options there. You can choose as many or as few as those that you'd like to. We'd love to get in touch and see how we can help y'all outside of this webinar session. Of course, this is an optional question, but we'll leave this up for a second as we have some of those questions rolling in here. Again, you guys can leverage the GoToWebinar control panel on the side of your screen. Submit those in, and if we do have any that either we don't have time to answer during today's session, or maybe we want to take this offline, have a little bit of a deeper conversation, we'll make sure that we follow up with y'all after today's webinar to get you guys the best information that we possibly can. Excellent. We did have one question that said, will you send out the slides, presentation, and resources? And the answer is yes. Yes, we always do after our webinars. We have an awesome YouTube channel that y'all can check out where we post all of that content there. So that's always available for you guys. We'll also make sure that we send that to your email inbox. So that should be arriving in the next 24 hours there for y'all. Ryan, we had another question that came in, and that asked, how often should I be reevaluating my risk scoring process? Can you speak to that at all?
Yeah, I think in general, you're doing some sort of annual review where you're looking into your program, you're doing some back testing, trying to make sure that the way you're scoring your customers or members is accurate. Typically, that's probably also going to be presented to, say, some sort of board committee or management committee. It's probably also getting looked at by examiners or auditors. So just kind of going through, doing some sort of check, saying, are people really where I think they should be in terms of risk, and validating that is great to do as an annual exercise. If you push it out farther, that may or may not be okay with your regulatory body. I think I typically saw it on an annual basis.
That's great, Ryan. And another question asked, when I am making those updates to my risk scoring rules, is that something that I need to reflect in my policies and procedures every time?
I think a lot of times those rules might not necessarily be in your policy. Some of them might be in your procedures as an appendix, where it could be, or it could just be a reference to whatever system you're using. If you're doing it in a system, there should be some sort of change management, which says, these are when we made changes, these are why we made these changes, here are the results. Outside of that, I wouldn't expect someone to just, every time they make a tweak in their system, to be going back to their policy, writing into the policy, going back to the system, making another tweak, and kind of back and forth. Referencing is probably totally acceptable.
That's great. Thank you for that. Here's one that asks, are there less common variables or data points that I should be factoring into my risk scoring process that I might not be accounting for today? Can you speak to that at all?
Yeah, there's some interesting ones. So if you're not using, say, like country corruption, that can be a good one. Really any of the geographic variables, although I think a lot of those are pretty well defined. Outside of that, specific types of transaction activity. So just making sure that if someone's doing X type of behavior, maybe that has a higher risk of money laundering for you, trying to factor those in. Typically, if you have some sort of information, say in your geography or in your in like specific business types that you're in that you can leverage, that might also be valuable. So for example, I can think of like if you had a larger municipal portfolio or something along those lines, a risk factor for you might be like how they're taking in or their tax cycle, if there's been anything there where like there's been decreases in revenues, or if you've seen, say, like negative news, bankruptcies, court filings, things like that. There's so many different things that you can pull in. It's just a question, does it really move the needle for you?
That's great. Thank you for that. Ryan, I think that covers all of the questions that we've got so far. Again, just because today's webinar is ending, that does not mean that your access to Ryan or his bank smarts is ending as well. Y'all can always reach out to us, and we're more than happy to answer any questions, comments, concerns that you may have. I will say we've got 2 more sessions in this webinar series coming up. So we'll be tackling transaction monitoring next. That's coming up in June. And then we're following that up with some case management and investigation tools in July. Those are live on the website if you want to register for those, which is very exciting. As I did mention, we will be sending out the recording, slides, and resources from this session tomorrow in your inbox for your convenience. And then after you close out of today's session, there will be a brief survey. We ask you to take a quick second and provide us with some feedback about how we did today, how you liked the content, and if there are any kind of topics that you'd like to see, so we can make sure that we're giving y'all the most valuable content that we can every single month. If you have any additional questions, if you want to learn a little bit more about RiskOut, or if you just want to say hi to Ryan and I, please stop by riskout.com. We're always happy to hear from y'all. We hope to see you guys on our next webinar. And Ryan, thank you so much for taking the time and sharing with us today.
Thanks for joining, everybody.